presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compac Market Wrap YouTube update for April 7th, 2025. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. First of all, a reminder, make sure you click on the subscribe button so whenever I post an update, you will be notified and you can watch it at your convenience. Boy, it has been an interesting week in the markets. Volatility at the extreme. Thursday and Friday, a couple of the worst days we've seen in the markets. Monday morning or yesterday evening, when I was looking at the markets, it was not a pretty picture. But from there, we came all the way back. So I'm going to get into a little bit of detail and let you know what I think, what is going on with the markets, and where we're headed next. Looking at the numbers, let's start with that. For the year, the market is down about 13%, the S&P. Most of it in the last couple of days on Thursday and Friday, down about 9.5%. So if you have an all stock portfolio, you should be down 13% or less. If you have a 60-40 portfolio, or if you have bonds and stocks in your portfolio, you're down 6-7%. Part of life. We've had a couple of great years in the market, and now we're getting some pullback or correction in the market. I know it's been volatile. I know the media is saying the world is ending and the sky is falling. Everybody ran out of the house and make sure that it doesn't hit them on the head when the sky falls. But then people looked around and said, wait a minute, it's not bad. It could get worse, depending, and I'll talk about some of the things that I'm going to talk about in a lot more detail, especially when I do a long, Javed and I are going to talk about that in the podcast in a lot more detail today, and just looking at the numbers overall. But if you have an all tech, you're in the Mag 7, well, you live by the sword, you die by the sword. You've heard me say that over the last 30 years. And that's exactly what happened. People who had concentrated portfolios, they're down 25, 30, 35% or more. That's where the problems come in. All the traders out there that were trading and buying the NVIDIAs and the Palantirs and the Bitcoin and all of that, when you go to those cocktail parties, none of them will say they own it anymore. It's not a topic they want to bring up anymore because they've given back all the money that they made and then some. That's why if you have the right balance in your portfolio, when you look at it over 2 or 3 or 4 or 5 years, you can see that you will gain more. There will be ups and there will be downs in the market. People are going in, going out, they're buying this, they're trying, think they can outsmart the market. And as I've said, you've heard me talk about this on the radio broadcast for the last 30 years. The market is the collective wisdom of the world. Anybody who thinks they can outsmart the collective wisdom of the world, either has got a lot of hubris or they're just plain stupid. That's really the way I would put it. And when you're young, I used to try and do that. I was a trader, how I started in the business. Traded commodities and you leverage 50 to 1, and I saw them go up and I saw things go down, and you're trading off the 1-minute charts and the 5-minute charts and the 15-minute charts and trying to do the wave counts and all of that. When you added it all up at the end of the year, a lot of these traders end up with no one because they make money on 6 trades and give it back on 1. All the people that had made all the money over the last couple of years in the tech was evaporated in 2 days or the last couple of months. That's why having the right balance, and you hear me talk about that repeatedly, to create wealth over a period of time, you have to be able to hold on to your positions in good times and bad times. Have the right balance in your portfolio and let the magic of compounding work for you. Looking at the NASDAQ, last week it was down 10%, S&P down 9%, Dow Jones down nearly 8%, Russell down 9.5%. Emerging markets, we saw them holding up a little bit better. Emerging markets, IFA 6.89, emerging markets only down 2.9%. So we're seeing foreign markets do a lot better as the US market is adjusting and US trade policy is going to adjust. Now we put tariffs on everybody. We are going to figure out now everybody is going to come. They're going to make deals. They're going to negotiate. Some deals will go through, some will not. Some countries will get tariffs, some will not. But we'll see some kind of rebalancing. It'll take time. In the meantime, the president is going to say, hey, we are going to keep these tariffs. When he says that, we markets go down. When he says, oh, well, the Japanese are here negotiating today, that helps the markets. Today we were down yesterday afternoon as much as 1,500 points in the Dow. What did it end up? Slightly lower today. S&P down nearly 0.25%. NASDAQ was higher today. So we'll see this time a tremendous volatility. But if you have the right shock absorbers in your portfolio, you can handle the volatility. Energy was down the most last week, down about 14.1% last week. Oil prices plummeted. Consumer staples were the best ones. That's the cereals and the soaps, things like that people have to have even in a recession. Question is, are we going to go into a recession? I think the probabilities have gone up. But if we do find some sort of balance and we get a tax cut that is not very large, do we not blow out the deficit in the tax cuts, but we have some kind of balance in the tax cuts, I think that'll be very positive for the markets. And that could be the next leg that pushes the market higher, that we get lower taxes, lower government regulation, which we're getting. We are going to get a rebalancing. I mean, if you look back in just 30, 40 years, it used to be 7% of the budget was government employees. Now they're 23%. So we are going to see some cuts that are going to be painful, some cuts that they'll find that one person, oh my God, he was essential and he got laid off or she got laid off, but they'll hire them back. Other people, yes, they are going to get laid off because the government has become too big and we need to bring it back to size. And that's what's happening. Yes, some of those people will find other jobs in the private sector, some will not. And unemployment rate might go up. And that's the biggest problem. But if the deficit goes up dramatically, then the interest rates will not come down. And that's where we will have a problem. We will see prices going up because of these tariffs. How much? If we keep all of them the way they are, about 1.5%, which will pull the Fed back from bringing rates down. But if we do just a slight bump in rates and we see some things coming down like energy and oil prices and gasoline, that could be a big boost, on the other hand, to bring inflation down. If we, at the same time, we take some of this tariff money, put it towards cutting taxes and reducing the deficit, that could be the best of both worlds. And I think that in the long term, but how much pain are we willing to take in the short term? That is the question. And I think, markets, the knee-jerk reaction is, oh my God, the sky is falling. But I think we are going to find some balance, but it'll take time to get that balance. And during that time, we are going to see volatility, where markets get one headline, they'll jump up, one headline, they'll come down, and we'll go back and forth until we find some kind of balance between what the tariffs are going to be, how much they're going to be, on what countries, and so on. We are going to see a rebalancing of trade, which I've talked about for 30 years. Said we need to rebalance this trade. As I said 25 years ago, when China entered the WTO, I can play those broadcasts for you, the radio broadcasts, where it said China is going to take all this money, they're going to get rich. They'll sit there quietly while they're getting rich. Once they get rich, they're going to take that money, put it in the military. That's when we'll have a problem. Well, here we are 25 years later, and we have a problem. Now we're trying to rebalance that and fix that. Will it all be fixed? The 25 years of problems in 2 days or 3 days or a week? No, it'll take some time. And during that time, make sure you have the right balance in your portfolio. That's what you will have to do. Oil prices are down nearly $5 a barrel from where they started the year. Interest rates plummeted down dramatically from 4.27 to 4.01 for the 10-year. We went up today quite a bit as the market stabilized because, again, what interest rates are worried about, yes, if the economy slows, interest rates come down. But if inflation goes up, interest rates go up. Tariffs will push up inflation to a certain extent. But if we do see the economy slowing, that should keep that in balance. If you see the economy slowing too much and we're going into a recession, then interest rates, if you said, go below 3.8, we could have a problem. Then the bond market will be telling us we're going into a recession. So right now we're at those crossroads, and I think we'll find balance over a period of time. It's going to be bumpy, as I've said at the beginning of the year, I said last year. Tariffs are going to be one of the biggest things, and the amount of deficits we do with tax cuts. Those are the two things that are going to impact the markets dramatically. If we do too many tax cuts, then we have to borrow a lot more money and interest rates will go up. That'll be bad for the economy. If we do too many tariffs, inflation will go up. That'll slow down the economy. It'll slow down the interest rate cuts. That's bad for the economy. Finding the right balance, which will take time, which we will do. Again, we have a lot of people that are foreign workers that work in the industry. Construction, 29% are foreign born. And now we can talk about illegals or legals. It's foreign born. Business services, 23%. Talking about other services, 22%. Transportation and utility. So about 20% of our workforce is foreign born. If we deport all of them, where are we going to find the workers? Where are we going to rebuild LA with all the homes that are burned down? Prices for reconstruction are going to go up dramatically. So I think we will deport a lot of the criminals and the bad actors that we have in this country. We need to get them out. On the other hand, there's some people, I think we'll find some kind of, that we need those people also to a certain extent. Looking at the jobs openings fell to 7.6 million. We were around 10 million at one point. So the number of job openings are coming down. ISM manufacturing and services fell to 49, below 50 for the manufacturing, which is contraction. Services, we're barely above 50, 50.8, which is still expansion. Challenger layoffs spiked. These are by a firm that follows layoffs. They were up by 275,000. Next couple of data, hard data points that we get, which will be inflation and all of that for April. That's going to be the number to watch. All the data we got was from March. That is before these tariffs went into effect, and we saw the markets have all the volatility that we've seen. You got consumer credit. CPI comes out later on this week at expected to be a 0.1. Core CPI. Again, these are all March numbers. I think everything has changed in the last week as we saw these tariffs being put on. These tariffs are much larger than what had been anticipated. So market was not prepared for this kind of blanket tariffs across the board. And we'll see if some of them are pulled back, some of them are negotiated, but those negotiations, and some might be increased on the other hand. Countries who decide to fight these tariffs, they'll have to pay higher tariffs. People who negotiate and find some reasonable solutions where we have reciprocal trade, where we can sell our products, as I've said, in their country, and they can sell our products in this country. Fine. We want to have an even playing field to sell our products, but we've got to build the factories. You can't build a factory in a day, so all of this will take some time. S&P plummeted, went right through the 200-day couple of weeks last week, and then week before last, as a matter of fact, and last week on Thursday and Friday, we gap lower. These are the gaps from Wednesday's close to Thursday's open, and Thursday's close to Friday's open. Today we were down all the way down to 48.35 for the S&P. We bounced back up and closed at 50.62, so we rallied about 200 points in the S&P from the low to the high. We should get a fourth wave bounce somewhere, back up. Then we'll sort of dribble around here for a while and then come down. Probably we could see a retest. So it'll take time to heal all of the technical damage that we have, and the markets will remain volatile. That's what you should expect, in the short term. We'll see sharp rises and sharp declines over the next couple of weeks. We've broken below the 100-day moving average on the weekly 100-week moving average. That usually is a sign that we are going to get a 20%. We're down about 17% in the S&P from the high. 20% down is a bear market. We could touch that. I wouldn't be surprised if we go back down to somewhere around the 4,800 number. And this is the fourth wave. And then fourth waves are not usually straight down. They're messy. They go up and down, up and down, up and down. And that's what we're going to get for the next few weeks until we get more clarity on a lot of these things. NASDAQ also down, wave 1 down, 2 up, 3 down. Now we'll see the fourth wave up, and again, choppiness for the next few weeks. NASDAQ, we came and touched the 200-week moving average, which is 16,410. Got as low as 14,784, and then we rallied all the way back up, closing at 15,605. NASDAQ has got a lot more. As I said, the dot plot turned negative a few weeks ago. These dots are above the market. That gives us a big, until we get that resolved, usually it's 6 to 8 weeks, sometimes longer, depending on if they're bear markets like we saw in 2022. This is 2022. You can see that we were down until about 2023. So all of these dots were above the market. That's a bear market. Now, are we in a bear market? NASDAQ, yes, we might be in a bear market. We could go down more because we had gone up so much. And some of these stocks are being repriced. NVIDIA, which is 40 times earnings, is down to about 17 times earnings at the low today. That is a more reasonable, but these companies are making money. They're not like the dot-coms, which had no profits, no money for years, and they were not expected to make money. NVIDIA and companies like that are making profits. They're growing, and that's why I think these are places to look for, and not yet, but places to look where you start nibbling at the market. Interest rates plummeted down to about 3.9 yesterday, came all the way back up to 4.21, which is the 200-day, this line right here, magenta line right here, 4.22. We got as high as 4.21 today, came back at the 200-day, and then we dropped back and closed at 4.15. Again, as long as we're above this number, which is right around 3.6, that shows, okay, we went down, fear, all of that came back up, and we'll bounce around here until we get a clarity on tariffs, inflation, deficits, tax bill, and so on. On the small caps, they have just broken right through on the weekly charts through the 200-week moving average, probably going to test these lows, which are around 160, 165. We got to 171 today, closed at 179. Again, third wave, fourth wave up, fifth wave down. That's what I expect in most of these markets. Gold looks like it's put in a top, fifth wave top. You know when you see 5, you're going to head lower. We broke below the 20-day moving average today. Next is 29.50. We close at 29.96, 3,000. Break below that, we could go to about 26, 2,700 for the gold market. That is the technical picture. But the most important thing I want to emphasize to you, have that balanced portfolio. If your portfolio is going up too much and you're feeling euphoric, you have a problem because you've got too much risk in your portfolio. It's going to blow up one day like the last couple of days. Then you're going to lose it all and then some. Then you're going to start building it back up. Then you lose it all. Then you build it back up, lose it all. And when you look at it over a period of time, you've gone nowhere. You have the right balance. And you go up slowly, come down a little, go up slowly, come down. That's how the stock market works. If you have the wrong allocation, call us. 800-388-9700 or send me an email at invest@compact.com and do it now. If you haven't done it yet, do it now. We'll be more than happy to sit down with you and show you how to get from where you are now to where you want to go financially. And don't forget to subscribe to the YouTube channel, the one that you're looking at right now. Click on this button and you can subscribe to it. So whenever I put an update, you'll be notified. Those are my thoughts. We'll talk a lot more about this on the podcast. You can go and download that from the App Store, Market Wrap with Mo, one word, Market Wrap with Mo and Sari, It's a free app. You can download it, and whenever we'll do a detailed conversation, about 45 minutes, Javed and I will talk about our views and our thoughts on that podcast in a lot more detail. Again, those are my thoughts. What you need to do is have that balance. Don't get swayed by all of the news, good news, bad news, up and down that you're going to see over the next few weeks. That is going to be one of the hardest things to do. I will be back with you at the same time next week. Until then, good trading.
This presentation contains the current views and opinions of Moees Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.